Hi, I really hope you enjoy this educational video. My name is Mark Byelich. I'm a certified financial planner, and my team and I focus on developing tax efficient or tax-free retirement strategies for our clients. We also focus on investment strategies that allow folks to eliminate the worry and have the potential growth that you need in retirement. So enjoy the video, and at the end, I'll tell you how you can schedule a no cost, no obligation consultation with me. Enjoy. But let's talk about the slot updates. A couple good ones today through the past week. So the first one talks about, and this is from Andy Ives. You all met Andy a few weeks ago when we were talking about net unrealized appreciation. So Andy writes about spouse as IRA beneficiary. Now, this may seem really simple. Most people have their spouse as their IRA beneficiary. Most people are similar ages, but some are not. And so how that spouse inherits that money and then moves forward with that IRA can sometimes be cause for discussion. I will say that, and you've heard me say this before, don't do anything too quickly. Don't be in a hurry to make these decisions. I'm working with a widow right now that is getting substantial pressure from two organizations who hold the money that's in her husband's name, IRAs, and a retirement account, a retirement plan. And it's nearly a level of harassment where they want her to open up accounts, transfer things in, and that is really not always the best way to act. Certainly not the way they're acting, in my opinion. So Andy writes, when a married IRA owner dies, the surviving spouse is oftentimes the beneficiary. Of course, there are instances where a trust might be named as an IRA beneficiary. We're going to talk about that with Sarah in the next month or so, or the children or a charity, or sometimes someone else is listed. Regardless, typically it is the spouse, and how that spouse treats the inherited IRA dollars is important. While at first glance, this appears to be a simple decision, there are multiple variables and options to consider. For example, he continues to write, is age. How old is the surviving spouse, and will that surviving spouse need access to the IRA dollars? If the surviving spouse is the wife and she's under 59 and a half and needs access, then establishing an inherited IRA, as opposed to moving the money right into an IRA in her name, might be the best option. The reason is that with an inherited IRA, you can always take, there's a required minimum distribution that you have to take. But you can always take the withdrawal, out of the IRA without a 10% penalty if you're under 59 and a half. So if my spouse, if God forbid I'll ever pass away today and my wife inherited my IRA or my 401k, then if she treated it as her own IRA and she needed access to the money, well, she would fall under the restrictions of not being able to access that money prior to 59 and a half without a 10% penalty on that. But if she rolled it into an inherited IRA, well, of course, she would have to pay tax on that money when she withdrew it, but she would not have to pay the penalty. So that's a nuance. It's really important. So the range of folks who we're working with are usually in their mid 50s to mid 60s. We certainly have clients who are in their 70s, and we have a few who are younger, but most of the time we're talking to folks who are getting ready or are right in retirement. So there are instances, unfortunately, when people suddenly pass away and they're leaving everything to their spouse, and they kind of have to unravel this. So spouses have options that other beneficiaries don't. Now, when you're talking about children or non-spouse beneficiaries, you run into that eligibility, right? Non-eligible beneficiary to hold the funds as inherited IRA and do the required minimum distributions. And there are some people, eligible beneficiaries, who can still do stretch IRAs, but most can't. We're talking about surviving spouses. Surviving spouses have the most leeway of how they can inherit those funds, and they're never taxed. As long as they're transferred properly, those funds are never taxed. And in fact, with a surviving spouse, even if you, God forbid, make a mistake and you do a distribution of those funds, and realize that it's a mistake within 60 days, you can potentially roll that back into an IRA, if only if you're an inheriting spouse. If you are a non-spouse, once you make a mistake, you're done. You're absolutely done. You can't put it back in. So Andy talks a lot more about that, but I just wanted to kind of paraphrase what he had said. In that, let me just see if I'm missing anything. I'll just read the last paragraph. A surviving spouse beneficiary has extra flexibility when it comes to claiming a deceased spouse's IRA. However, be careful, take the proper steps. Some variables to consider include the age of the deceased spouse, age of the surviving spouse. Does the surviving spouse need access to the dollars? What type of IRAs are involved, Roth or traditional? That's a great point. A word to the wise, all beneficiaries, spouses and non, should seek professional guidance before making any final decisions when inheriting an IRA. Yes. Talk to somebody, talk to us, talk to somebody who's qualified in this area. You know, people that you hear me every week talking about these mistakes that are being made. At the end of this week, Thursday and Friday, all day Thursday and Friday, I thought it was also Saturday morning, and I'm relieved to see that it's not Saturday morning this year. But Thursday and Friday, I'll be in an online conference, my semi-annual Ed Slott training conference, and we'll hear all about mistakes that have been made throughout the past year or so that have caused people significant tax dollars and frustrations and sleepless nights, and there's no reason for it. Seek qualified help. Have your team in place. Seek that qualified help and make the right decision. And sometimes it's hard because it's a difficult time, especially when you need money. Okay. And by the way, you could have millions and millions of dollars and still need access to cash that you feel you may not have access to. So it's not about how much money you have in general, it's how much you have available to you. So that can be trying at times. And when you're talking to different agents, investment advisors, financial advisors, sometimes you're getting conflicting information. So it can be very, very challenging. All right, so this is kind of the Slott mailbag. This comes from Ian Berger, another one of the Slott IRA analysts, another great guy. He received a question, and the question is, I am retired and turned 72 in September 2021, so I must begin required beginning distributions, RMDs, by April 2022. Now remember, the first year you're required to take the required minimum distribution. Your required beginning date isn't until April of the following year. The person goes on to write that I have traditional and Roth IRAs as well as defined contribution plan with a former employer. I understand I must withdraw my RMD before withdrawing any amount for anything else. That is a Roth conversion or something like that from both my traditional IRA and my defined contribution plan. But is that requirement limited to withdrawals within each type of plan, IRA and defined contribution? In other words, am I allowed to take an RMD from my IRA and then do a Roth conversion from that IRA this year while delaying my 2021 RMD from my defined contribution plan until April 2022? Good question. Ian writes back, Tom, the writer is Tom. Yes, you can take your 2021 RMD from your traditional IRA this year while delaying your 2021 defined contribution plan RMD until April 1st. They are separate entities that require separate decisions. Keep in mind that delaying your first defined contribution RMD means you will have two RMDs in 2022, one for the 2021 that he pushed off until 2022, and of course, one for 2022 that's due by the end of the year, 12/31/2022. So you got to make sure that that's going to work well for him. In some cases it does, some cases it doesn't. But Ian makes a good point here. There are two different things. People get retirement plans, 401ks, 403b plans, and IRAs. They get the rules confused all the time because the rules for IRAs are different than the rules for retirement plans. You have to think of them differently. Tax treatment may be the same, but they're very, very different entities. So the next question, the account owner, age 65, dies in 2021. They just come out shooting. They didn't even say anything. They just say the account owner. So the account owner, age 65, dies in 2021 and is survived by a 35-year-old spouse. 30 years his junior, sole beneficiary of his traditional IRA. So he's 65, he's married to a 35-year-old. What are the rules for the surviving spouse? Many thanks, John. So Ian writes, John, the surviving spouse has two options. She can remain a beneficiary of her deceased husband's IRA, or she can move the IRA funds to her own IRA, a spousal rollover. So we talked about that in the article just a minute ago. Remaining a beneficiary makes sense if the surviving spouse needs to tap into the inherited IRA funds. This is a perfect example. So this person is 35 years old. She has a long time to go before she reaches that 59 and a half age. So if she took that IRA and moved it into her own IRA, which she could do, then she would be subject to the penalty for being under 59 and a half if she needed funds. If she treats it as an inherited IRA, well, she would be exempt from that 10% penalty because she could draw that. But even if she doesn't need the funds from the inherited IRA, she would be forced to start taking RMDs in 7 years when her deceased husband would have turned 72. That's a calculation that's different for everybody. So it depends on what age the owner is when he or she dies. We talked about that in the previous article. She could then do a spousal rollover with the inherited IRA. Spousal rollover can be done at any time, but doing it before 59 and a half would expose her to the 10% penalty on any distributions. However, if after the spousal rollover, RMDs would be required until she turns 72, a long way off. So what Ian's saying is you could do it this way. She does it as an inherited IRA until she's 35. 7 years from now, she's 42. Now, time has gone by and she's realized she does not need any distributions from that. At that point, though, she would be required to start taking required minimum distribution because her deceased husband would have reached the required beginning date, right? Age 72, the age to start that. So Ian is correctly saying that she could, at that point, under the current rules, say, you know what, I no longer want this to be an inherited IRA. I want to treat it as my own. And then she pushes off required minimum distribution until she's 72, which is a long ways away. And she can do a lot during that time. Now, one of the things that she can't do during the time that's an inherited IRA is do a Roth conversion. So there may be a reason to move it to treat an IRA as her own before that time. All right, let me pause here. Let me see if there's any questions. There's a lot of content there, and there is a question. Gerard, I can always count on you for the question. All right, let me get ready for this. Hold on, I got to move it out of the way so it's not my notes. Gerard writes, if a non-spouse inherited into a BDA, I'm sorry, I have this up on my side screen. If a non-spouse inherited into a BDA account, so that's a beneficiary designated IRA, so that's an inherited IRA account. In 2014, what rule applies? 5-year RMDs or over 10-year Secure Act RMDs? Well, that would be if a non-spouse inherited into a BDA account, into what rule applies? I'm not even sure at the 5-year. It would depend on the age. It would depend on a couple of things. The age of I feel like you're testing me here. So this feels like a CFP question. So it would depend on the age of the spouse who passed for whether the 5-year rule applies. But it's likely in 2014 that non-spouse could treat it as a stretch IRA and stretch it over their lifetime as long as they've acted correctly and transferred it the correct way. So I hope that answers your question. You always give me challenging questions. Good question, though, George. All right, so moving on from the slide information, we're going to talk about. Did I miss anything? We're going to give some market updates. So we had a positive market last week. The markets are up about 1.58. The S&P, or excuse me, the Dow Jones Industrial Average, the S&P 500 was up a 1.84. The NASDAQ was up 2.18. The MSCI World Index, so that's the global larger economy countries, 2.52. That was up. That's not the U.S. What we call emerging markets, so smaller economies, 2.13. So across the board, good week last week. We still have really strong year-to-date numbers, 20.38% for the S&P 500, 16.98% for the Dow Jones, and 16% for the NASDAQ. So hopefully, we've got about 2.5 months. Hopefully we continue with that for the rest of the year. Interest rates are down a little bit, 1.57%, compared to 1.61% the week before. So just a little bit of fluctuation, very normal there. Still super duper low interest rates though. Let's talk about some of the analyst opinions. So BlackRock continues to talk about inflation, and we're going to talk about the Bureau of Labor Statistics report that came out last week. I think it was the 13th. But BlackRock continues to talk about inflation, but they're easing their talk, at least this week, about it. They're right. Global prices climb. The inflation pressures we expected are here. So again, BlackRock began talking about this over a year ago, the risk of inflation, when they were one of the first ones to really start talking about it. But the inflation pressures we expected are here and are persistent. This is not stagflation, and BlackRock, we remain pro risk, but confusion over price surges is a risk. So that is a really just short thought about how their analysts are looking at this. They're basically saying, all right, our inflation's here. You've all heard the numbers, so probably, but we're going to talk about it. Year-over-year numbers, and we know what Social Security is projected to increase next year, or is going to increase next year. So they're saying, okay, we're here. It's not like the 70s where we had stagflation, and the economy was potentially stagnant with that, and they remain pro-risk. They think that the economy is going to continue to grow and bring the stock market with it. But confusion over price surges is a risk. The way I'm reading that is people are a little struck by this. So we're seeing gas prices climb quite a bit. Food prices, we're seeing these things every week. We're seeing the effect of on things. I've seen a couple notices from, I know I talk a lot about local restaurants, but that's really kind of like a really good barometer of what's going on out there. But they can't get things, they can't get help, so they can't get the goods, they can't get the help, and they feel like they have to charge outrageous. Somebody was talking about we'd have to charge $23 for an order of wings to make any money on the wings, because you can't get simple things like chicken wings. So I guess we could probably all do without chicken wings, but that just gives us a flavor of what's going on out there. So when consumers certainly consumers, when they see these things, they just might pull back and say, well, wait a minute, what's going on? Things might get really bad. I'm going to save my money. And when that happens, we can potentially see a drop in the market. I have a lot of concerns about volatility into the rest of this year and certainly into 2022. My hope and my thought is that we'll probably end 2021 in strong numbers. I don't know if we'll continue to climb. My personal thought is we'll probably be pretty flat for the rest of the year, but there is a significant risk that we could drop 10% or so by the end of the year, very similar to what happened in 2018. But that there is price confusion out there. So they give an update. They just gave an update about global equity. So global stocks rallied as the third quarter corporate earnings season kicked off with strong results in the U.S. They're focused on signs of cost pressures. And they're a week ahead, they're watching the Global Purchasing Managers Index this week for readouts on manufacturing bottlenecks and strength of the economy restart. The riverfront, I haven't really included in the past couple of weeks because I'm a little disappointed, and I should call them, because they're really giving us less analyst statements, but more of a sale on active management. And I understand it because they're active managers, but that doesn't help us. So Riverfront's been that category's been blank for a little while. Prudential had some good thoughts on the Chinese economy, and I'll read this to you. The Chinese economy has developed massive structural excesses over the past decade, DeLucia writes, most notably in the real estate and manufacturer sectors. These imbalances include increased debt, heightened financial risk, decelerating economic growth, and economic instability. Recent developments, he goes on to say, surrounding China's property giant Evergrande have raised investor awareness of these worrisome underlying imbalances. Policymakers will do whatever necessary to prevent contagion from its collapse, propping up suppliers, healthy developers, and homeowners at the expense of world bondholders. Evergrande is a microcosm of the leveraged Chinese housing market. A bankruptcy can be managed to avert contagion, but the bigger issue is how policymakers will address the growing vulnerability of China to its oversized property market. So what are they saying here? What he's saying is that China is incredibly overleveraged. It's been so for some time. So there's a real concern about this high level of debt and their ability to apply the monetary and fiscal stimulus to continue to hold it afloat. So, China kind of, they've kind of leaned towards a more capitalist structure, and now you see the leadership in China pushing back. So, China can be seen as kind of an unstable environment economically right now, and there's a tremendous amount of risk of China suddenly has consistent issues and was facing massive bankruptcy. So, interesting look from Prudential. You can probably Google that and pull up that report if you'd like. Now let's talk about the Bureau of Labor Statistics report that came out in that came out in October, on October 13th. So the 12-month rate of inflation, consumer price index, right? That's the rate of inflation, very broadly stated, from September 2020 to September 2021 was 5.4%. So that is a huge number. We have seen this coming, of course. As I said before, we're living it. Some of the biggest increases we saw were in energy, 24.8%, gasoline, 41%. So the broad energy sector, 24.8%, digging into it. Gasoline at 42.1%, fuel oil. So I'm actually looking at contracts for fuel oil right now because I have oil in my house. I wish there was a good alternative for it for me, but there isn't. 42.6% increase over last year. So all items less food and energy. If we took out food and energy, all other items increased 4%. So that's a big number, and that is concerning because, you couple that with millions of people retiring every day as baby boomers. There's a certain amount of money that they've saved up, and whether you have $1 million or $10 million, your first fear is always, do I have enough to live on? And we can do a lot of planning around that, and we really pull out the numbers that we need to assess as far as what your income is going to be and what your expenses are planned to be. But when we have to have significant increases like 5%, that's going to mess up anybody's plan. So we've got to be concerned about this. The question is, how long does it continue, and does it continue? If we're looking at 5.4% on average or 4% on average for a decade, it's going to be very, very challenging. Could it be that? Well, sure, it could be. We've had very, very low inflation for a decade and a half. So, we could certainly be in the high single digits for some time. Let's talk about this next great nugget of information. So we've talked about the debt crisis. We've talked about Social Security. Now let's talk about the Social Security and Trustees report. So I didn't talk about this when I got back from vacation, but on August 31st, the Social Security Administration released the Social Security and Medicare Trustees report like they do every year. So there's been a lot of discussion in the press about this, but you probably know already that Social Security shortfall, because of COVID, they say, grew by 18% in the last year, and that's the most it's grown since they've been tracking this. That's a $3 trillion increase, and that means it's more likely beneficiaries will face reduced benefits in the future, and the longer we wait to correct it, the harder it's going to be. So we had known that the trust was going to be unfunded, right? Go to zero. That means 78% of Social Security benefits will be available. So that doesn't, so let me back up. So now it was 2035 when the trust fund was set to go to zero. Now it's 2034. So it's 1 year earlier because of this, the shortfall increase. So what does that mean? It doesn't mean that Social Security payments stop. It just means that we can't make up the difference. There's a 22% difference now, right? 78% of the scheduled payments will be able to be met. The 22% is where what the trust is used for, the difference, whatever the difference is. Right now it's less than 22. But in 2034, it's going to be 22 and there won't be any money left. So 78% of the Social Security payments is, what's going to be available from payroll tax. So there are definitely things that Congress can do between now and then to fix that. The question is, do they have the stomach to do it? So they either have to increase payroll tax, which is going to affect everybody. There are definitely proposals out there to limit the caps on Social Security as far as the payroll tax. But it's unlikely, certainly, that given the way Congress is right now, that they're going to act anytime soon, because 2034 is forever for Congress. Remember, they're thinking about next year's election. The members of Congress, they have a very short window, and it depends on what their term is, whether it's a congressional, a Congress assembly, the U.S. Assembly, or whether it's the Senate. They're focused on their next term. They have a hard time thinking into the future, but we must do that. So it's very, very unlikely that nothing's going to get done until this is a crisis mode. That's why we have this debt ceiling situation almost every year now, because they wait until the very end to address these things. I can't see that anything's going to be done between now and 2033, when, let's face it, by the time we're really at crisis, we're probably going to get down to a 2029 point where the trust is out of money. So we've got probably 8 years. And again, that's an eternity for a congressperson. The author of this article writes that we live in a state of denial about Social Security. And boy, isn't that the truth, because very, very few people talk about this. When I bring this up in class, there's always some naysayer out there talking about how Congress is going to fix it. They did it in 1983, and things are much, much different now. But this is a big concern. We all rely on Social Security. So maybe not my generation as much. I'm 53 years old, but certainly the folks I see every day who are nearing or entering or have entered retirement. So the most challenging person who becomes a new client for us is someone who's already retired and has made decisions prior to retirement, but we can typically deal with it. But Social Security is a big decision. And it's something that you also count on. It's not a guarantee. We know that. There's a Supreme Court decision that said, you're not guaranteed this. This isn't right. But we all count on it. And if there's a reduction of Social Security, that, if you think about it, if there's an increase in tax, a reduction of Social Security, and inflation continues over a period of time, that's going to be devastating for a lot of people. So how do we address this? Well, we've got to have first of all, you've got to have your plan in place. Of course, this is what I'm going to say. You've got to have your plan in place, and then you got to know kind of what these what ifs are. For most people, we have a legacy longevity amount that we identify and say that's probably you're not going to need this money. But there are instances where you may need it. And economic disaster like this, right? Social Security benefits get cut. Inflation continues. There's significant changes in the market, significant changes in your life. There's a lot of things that can affect that. So if you have $1 million sitting inside in legacy longevity that you'll probably never touch, well, you can grab that for certain reasons, but you've got to have that contingency in place. And it's good to know that, because it helps you make your decisions today. So let me get off my bandwagon there, or my soapbox. It's not bandwagon, it's a soapbox. So they're the things. Now, it's not all doom and gloom. You can manage these things, but you don't have any chance if you're not doing any planning around it. It's just going to be absolute luck, and you can make a significant decision today. Buy a house in Florida or Jersey Shore or wherever, that may not be the right decision for you. Maybe you have enough money for that. Maybe you don't have enough money for that, but we often just kind of shoot from the hip if we don't have a plan. So now let's talk about planning. Let's talk about year-end planning, because we are here. So wonderfully, one of our, and I say that sarcastically, one of our providers that we use for principal protected fixed indexed annuities that allow for Roth conversions, they told us that they need to have their Roth conversion documents in-house in good order, which means all the I's dotted and the T's crossed, by November 19th. Well, that's a full month sooner than what they typically have. So this is why it's important to have these discussions throughout the year and be ready, because we have some tweaking maybe to do for a couple clients, but we have a really good idea of what everyone's doing. And in fact, a lot of folks have already done their Roth conversions for the year. So we're talking now, when we're talking about year-end tax planning, we're talking today about Roth conversions. We talked about income a couple of weeks ago. Now today we're talking about Roth conversions. Roth contributions are different. You have until, the IRS code says, until your tax filing deadline for the next year in 2022. So that's probably April 15th, but unless that falls on a weekend, to do a Roth contribution. But if you can. But a conversion is a different story. A conversion is when you take money that's in your traditional IRA and you send it to your Roth IRA and you pay tax doing that conversion. And there's a lot of good reasons to do that. There are some reasons not to, but if you're planning on doing it, you have to have it done by December 31st, the IRS says. But your custodian might have a different date, and I guarantee you that they will. So if it's Fidelity, they might say, you got to have everything in by December 15th, or we're not guaranteeing it. In the case of the company I just told you, they said November 19th, or we can't guarantee it. And they'll do their best efforts, but we want it done. So be aware of those deadlines. If you're not working with us and you're doing your Roth conversions on your own, be aware of those deadlines. Be aware of Roth conversions you've done so far this year. The ability to recharacterize Roth conversions was taken away from us in 2017. A recharacterization is simply a do-over. And prior to 2017, we were able to recharacterize a Roth conversion up until October 15th of the year after the year that we did the conversion. That was taken away from us. So that was a very valuable tool that was just jettisoned from the toolbox, never to be seen again. So you've got to be very, very deliberate and clear about the conversion strategy and the steps. And people forget. I hear all the time, oh, I forgot I did that. Oh, I already converted $100,000. I forgot about that. I took a distribution of $50,000 from my IRA to buy a car or pay for the shore house. I forgot about that. So even though it happened in the last few months, right, or in 2021, maybe it happened in January, maybe it happened in May, people forgot about it. That may sound silly, but it happens all the time. So look at your past and planned conversions. Distributions from IRAs and retirement plans, the ones you may have forgotten about. Go back and check with us. We remind people all the time. You took $21,000 in April. Oh, that's right. Income. How about your income? I was talking to a client who had a massive bonus this year. Wasn't considering that. We're not doing Roth conversions for him this year, unfortunately, because it was a massive bonus. And of course, deadlines. So be aware of your income. Go back and look at those deadlines. Roth conversions are a very, very powerful tool for the success of your plan, certainly in a tax-efficient plan. And as you've heard me say, having a tax-efficient plan is often a game changer, a life-changing event for people. And I can't emphasize that enough. So that's Roth conversions. All right. So this is not too early to start your year-end planning. As I said, we have this early deadline, but other companies are working with the same things. So let's get it in now. Let's get it done. Let's retire it early in the year, and then you can enjoy your year-end. Because the worst thing is, once 1231 passes, you can't go back. You can't do a Roth conversion in 2022. You can't do a Roth conversion for 2021. So this is a powerful tool. It's a key to a successful plan for a lot of folks. So let's make sure we have everything done. Okay, I won't repeat that. It is 10:40. Don't forget about our class tonight if you're attending. We had some late people attend or sign up. If you didn't get your workbooks, if you've attended before, we did not send you workbooks because the workbooks aren't updated for 2021. What you have is access to our website with the updated charts and I recommended some videos in prep. But it's going to be a fun class, 6 hours of instruction. Even if you've taken it before, feel free to take it again. It's a really good refresher for you. It's important for you to know and remind yourself why you're doing these things that are kind of out of the ordinary. Remember, we're marching with a different drummer. We are, this group of us. There are most people who are still in that tax-deferred paradigm. Still, being told not to pay their taxes early, to put off taxes until they absolutely have to take them, and they won't know what their tax rate's going to be. The folks we work with, you're going to know what you're paying, and you're going to know. We did comparison. One of the things you have to watch out for when you're doing Roth conversions is the income-related monthly adjustment amount that's referred to as IRMA, and that is an amount that you have to pay more for Medicare. So it's a Medicare premium additional amount, and it can be significant. So $400 or $500 a month more, more than that it can actually be. But I did a comparison for a client because we put it on a spreadsheet and said, well, what would it cost if you didn't do the conversions and you're paying IRMA, not until you're 72, but you're paying that for the rest of your life. And we did a couple comparisons, and it was $100,000 difference. So that is paying all of your IRMA costs up front during that period of time. I think his period was a 7 or 10 year period, and then never having to pay it again under the current rules. Or waiting until you're 72 and having to pay it and then paying it over the lifetime. He was saving, under the current rules, $100,000. Well, I think $100,000 is a lot of money. So you had to consider these things. So it's good to be reminded. It's good to review. Join us in the class if you can. I know you've all received emails. If you need to make an appointment, you're going to have the opportunity to schedule time with me as this webinar ends. I'm looking forward to seeing you all next Tuesday. And that's it for today. Have a great week. Take care. Hello again. I hope you enjoyed the video and perhaps you learned something new that can help you. If you want to schedule time for me for a no cost, no obligation consultation, you can use the link in the description and schedule a time that works best for you. If my schedule is full and you can't find anything, don't worry. Send us an email and we'll find a time that works for you. I look forward to speaking with you soon. Thank you. Have a great day.